This is our market measure sponsored by SIBO. It's Dr. Jim in the house for his first market measure. Let's see if he can figure this out. First slide, John. In our studies, we've discussed how our view of market efficiency is somewhere between semi-strong and the strong version of efficient market hypothesis. Would you say you're in that camp, Mr. Schultz?
This is maybe a longer thing. Not necessarily.
Okay, I'm in that camp for sure. Jim is a guest host today. This is why we don't have guest hosts usually. But Tom, Tony, and the research team are in the semi-strong to strong version of efficient market hypothesis.
Well, normally when you say we, it's all of y'all and then it's me, right? So now I'm just going to voluntarily put myself outside of that. I think the emotional reaction of the market in the search for equilibrium in the short term is more powerful than the models give it credit for. I'll just say that.
In other words, risk and return for a particular trade cannot be manipulated, only understood and managed accordingly. So let's test this theory with two popular ETFs that are both very diversified, but they have different underlying prices, implied volatilities, and components. We're going to look at the SPY and IWM. Now, just for the record, I will tell you that right now, I happen to be short SPY and long IWM. Not because we were doing a study here today. I've had this position on for
it's been a while.
2.5 months.
Yeah, it's been a while.
Today it's working. Okay, by conducting the same trade on each over a long period of time, what does our average P&L and short-term risk profile, volatility P&L, look like for each? And is there a risk-return advantage of trading one over the other? I'm going to ask you this because the first question is not fair. The second question, not fair to ask. Second question is, do you think, because Jim has not seen this yet.
I haven't.
Do you think there is a risk-return advantage of trading the S&Ps over IWM?
So if I had to guess, I'm going to assume, having not seen this, that IWM could potentially give you greater returns, but SPY is going to give you lower risk. So again, it's gimmies and gotchas. You pick your poison, as you like to say. And so that's what I think you're going to be up against. I'd be surprised if the results suggest anything other than that. But I've been surprised before.
You'd be surprised if the results suggest anything other
than lower risk with SPY, higher returns with IWM.
Okay, that's fair.
Not necessarily the holy grail of both with one.
I'm going to say that the risk-return advantage of trading one over another is going to be virtually nil.
So you're saying it's nil when you factor in both risk and return?
Yes.
Okay, I agree with you. But I think depending on how the guys and gals sliced up the data, I'm curious to see if they're actually kind of pinpoint the return aspect and the risk aspect.
Okay, because that's the question here. 2013 to present, 12 years worth of data, 16 delta strangles in both. 3 lots in IWM. On average, the SPY is around 3 times the price of IWM. Okay. 1 lot in the SPY, 45 days in both, managed at 21 days. We recorded the win rate, the average P&L, the volatility P&L, and the return on investment. All right? Let's go to the next slide. And let's take a look and see where we are. First, the win rate between the two is nearly identical. I don't think that any of us would be that's surprising to any of us. I think that whatever you do, regardless of implied volatility, regardless of everything else, the win rate's going to be virtually the same. And we need people to understand that that's how this works. The win rate's always going to be the same, nearly identical. This suggests that the deltas are priced efficiently across these products, even though the components are completely different.
Yeah.
Agreed?
I would absolutely expect that. I would be shocked if it was ever anything other than that.
I agree with you. Let's go next slide. The key takeaway, however, is that the ratio of risk reward for these strategies is astonishingly close, with 36% more expected risk and return for IWM.
That's what I said.
Jim said. And the actual historical risk, the actual historical risk and the return numbers fell in line almost perfectly.
Which is what you said.
Yes, which is really interesting. Well, we've been doing this for a long time. So what's so funny about this is the average implied volatility. You can see the IWM is always going to be higher, but we did a ratio here. Ratio of IWM to SPY was 1.33. And you can see right here, the average P&L of the strangles was greater for IWM. The volatility of the P&L was also greater because you make more money, you have more volatility, and the return on investment is a little bit higher, but the ratios are all virtually stayed the same. Let's go to the next slide.
So, okay, well, yeah, let's see what the.
Okay, we can go back one. Go back one.
No, I was just I was curious how you take this information and use it. So how is this information?
I'll tell you exactly. I'll tell you exactly how I do it. I take this information because I recognize that my decision over what to trade, this has nothing to do with like a pairs trade on that I have. But if I was going to do a strangle, my decision to put the position on would be based on implied volatility rank, not based on whether or not I like SPY, I like Dow, I like Qs, or I like IWM. My decision is based on where is the greatest opportunity, because the pop is going to be the same no matter which one I choose.
And that is the beautiful thing about being product indifferent and having so many different opportunities, right?
Yes.
Because it doesn't matter. You're right. When you're looking at strikes, you're looking at deltas, you're looking at probabilities, SPY, IWM, Coinbase, whatever, that is going to be kind of uniform across the board. And it's a beautiful thing.
That is 100% correct. Let's go to the takeaways. Risk and reward are priced extremely efficiently over time in liquid and diversified underlyings, even if the components are completely different. That's why we focus on implied volatility. Comparing implied volatilities across different products can be used as a proxy for comparing the two products' risk and return characteristics over the long term. In this study, we showed how the higher implied volatility underlyings, the higher implied volatility you got, historically, the higher the P&L, but also equivalently higher risk. Sorry. Equivalently. Yes.
Aren't you glad I'm here?
Equivalently.
Aren't you glad I'm here?
S&P's just rallied 50 handles.
I mean, that was impressive. NASDAQ's now only down 270.
Yes. Well,
so I wonder if, the Trump tariff meetings aren't until later, right?
Well, obviously it started now.
I just wonder if there's been some news that hit the wire.
Well, they were just down 115 and now they're down 70. So I would say that